This wasn't necessarily just a panic sell-off. I think it was more a signal of what's to come. The Dow dropped Friday over 2,200 points. Tech got crushed. Safe havens surged. But here's what no one's saying. This isn't necessarily a panic. It's actually positioning. The tariff war, of course, escalating again. The market's reaction was exactly what you'd expect if we were entering something bigger than just your typical correction, which we've had plenty of in the last few years. In fact, since Trump was president, he got elected president the first time, we've had 3 corrections. This would be our 4th correction, but something's different about this one. So I'm going to show you kind of where the positioning is going, where the sector rotation is going, how this setup compares to past major corrections, and why this bounce that everybody's expecting to come, and I think will come pretty rapidly, may not be the type of bounce that starts us on a new bullish trend, but may ultimately be another failure. So let's go ahead and get started. Today is Friday, April the 4th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching on our blog, be sure you subscribe to our daily Market Outlook email newsletter. You can do that when these pop up here. Also come down here to the bottom. You can subscribe to our website, subscribe to get notified when these posts are updated by just clicking on this little bell down here at the bottom. Here's where our Market Outlook live video is. You can see when I take a look at the trades and review the trades that we've done in past Market Outlook videos, see whether we should get in or stay out of them. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there, right there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. That pops up as well. Eventually, it will pop up here. Hit that like button right down here. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. Let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we finished the week with a cluster, with an oversold cluster. Obviously, as big of a drop in 2 days that we've seen in a really long time. If you take a look at the 2-day drop here, let's just move this off to a 2-day drop. There we go. So over 10% in 2 days. We have to go back to COVID to have that big of a decline in just a 2-day period. As you can see right over here, we had a 2-day period of where we dropped, let's see, how much did we drop? 13%, almost 14% in 2 days. We go out to some of these other corrections that we've had. 5% was the biggest 2-day. 5.29 was the biggest 2-day drop during that correction. Here's the early part of 2018. 6% was the biggest drop we had there. Here was 2016. We had a 5% drop in 2 days before rebounding pretty quickly to 3% gains in a row. 2015, when we had that correction, we had a 7% drop with a 5% gap down there on August the 24th of 2015. Going out to 2011, so about in this area here, our biggest 2-day drop then was in August 8th. We had a 6.6% drop, and then now we're going out to 2010. Our biggest drop was almost 5% a couple of times, and then finally during 2008, during the washout phase of 2008, we had a 2-day drop of 13% again. Again, that was right in the very worst of the washout phase there. We did have one drop here in October where we dropped 11% in 2 days. But again, nothing close during the beginning of it. This was the beginning stages of that correction, nothing even close to 10%. If I were to go back out even further, so we saw COVID, we saw the worst of the 2008. Let's go out to 1980. So we can see the 87 and then the 2000 bear market during the washout phase of that 2000 bear market, which was right in this area here. You can see in July 2002 we had a 7% during the washout phase of that bear market, so nothing anywhere close. And then 1980, so you can see a few times here in 98 we dropped down 7%, a couple of times, once in 97 and again in August of 98 when we had that pretty big correction there. And then finally here's 1987, and you can see we had a 2-day drop of 24% and then 16%, that third day, day 2 and day 3 of that 3-day move. So day 1 and day 2 was 24.5%, day 2 and day 3 was 16% drop. So, a little bit bigger. And those are the only times, at least in modern history, the modern 500 stock, composition of the S&P 500, because the Great Depression, the S&P wasn't a 500 stock index. So in modern history, since the late 50s, we've had 1987, COVID, and then the end of the Great Financial Crisis, the washout. Those are the only times we've ever dropped this much, this fast in such a small period. So it's not surprising it would produce a cluster that we had here on the daily chart. And again, we're more than 10% below the 30-day moving average. That is actually pretty common. Just about every correction we have outside of 2022, we never really did get there during the 2022 correction. Remember, the VIX never really jumped too high during that particular correction. But you see 2020, COVID, we got a lot further below 10%. 2018, we got below 10%, below the 30-day at the worst of that. 2015, we got below it right there in August, right at the very beginning. 2011, we got below, more than 10% below. 2010, we never really did. But then at the beginning, again, of 2008, we came close over here, down almost 8.5%, 8.25% at the very beginning of that correction. And then, of course, during the washout phase and then the retest phase of that bear market, we got below 10%. So it is relatively common to get below 10%, but you notice it's not very common to stay that far stay down there. And again, both your short-term sentiment lines are extremely oversold. So both of them down below the 5th percentile. So it's not very common to get a cluster with those two as low as they have been. You can see the last time we had both lines below the 5th percentile. Again, we set the low point that day, and it was a bull tag, but we set the low point that day and rebounded back up to the upside. If I take a look at the NASDAQ 100, I don't know why my camera keeps messing up on me here. It also got a cluster down more than 10%, 12% below the moving average, coming off of a bearish near-term peak, obviously setting a bearish near-term low. Your Dow Jones Industrial Average, eventually, here, let's try this again. The Dow Jones Industrial Average also, with very bearish short-term sentiment, did not drop more than 10% below the moving average. And the intermediate line is actually still above the 20th percentile. So it is still, no cluster, though. That's about as close as we got at 21.4. And then finally, your Russell 2000, which has been the most bearish, but came off the lows of the day more than the others. You can see it was down more than 10% below. It did get a cluster. Its momentum line bouncing up a little bit off those extreme lows because of the lower shadow that we had there. But remember, the Russell 2000 was already in correction mode because it already had the pullback and the failed bounce with the bear tag that we never did get on the S&P. We never got fully up to 5% there. We did on the futures contract. So when you look at ES, that did get to, but it still didn't get to a bear tag, and neither did the SPX on its market forecast chart either. And then now obviously down to lower lows. In fact, we're below the last, here's the last intermediate low that we're obviously failed on the bounce. Then there's the low before that. So not surprising, below that low. There's the low below that one. So we're flirting with the low point, the intermediate low point from last April. As you can see, the 1 year decline is negative now. We are down 2.5% over the past 12 months. Again, just to kind of give you an idea of how significant that is. when you look at the rate of change, so that would be the 252-day rate of change, you can see that we are negative. And the last time we went negative on an annualized basis was 2022, kind of in the middle of that correction, and we obviously went down below the 10% mark. So did COVID. So we did that during COVID. We also got down a lot further than just 2% during the 18. So I mean, that's during corrections, you drop below 0% on a 1 year rate of change, and we have just barely done that here this week. Let's take a look at the weekly chart, and you can see last week's candle. Again, not very good at all. We got the death cross coming on, which we haven't had since early 2022. Was the last time we had a death cross. Again, you typically get a death cross during corrections, and we're getting that now. Minus 0.25%. You can see the size of the candle is not the biggest it's been. We actually had a bigger candle during June of 2022, and then we obviously rebounded off of that low point. And we'll see if that ends up being the case here. If you look at the market forecast on the weekly chart, since this was the end of the week, you can see again the intermediate line is now crossed into bearish territory. Dark pink shading. I told you last week we had dark pink shading and a red line. Obviously now we clearly have dark pink shading and a red line. We got a bull tag. We were still kind of holding on to that bull tag last week. Obviously now we're not holding on to that bull tag anymore, and you have bearish short-term sentiment with the second straight day, and we are 13% below the 30-week moving average, which is about as far as we got back here in 2022. And you can see COVID, we got worse. 2018, we got a little bit lower than that. So this is a pretty decent low here below the 30-week simple moving average. You can see in 2008 at the beginning we got about this low, 10%, and then we rebounded, and you can see during the other bear market, 2000 to 2003, 98 correction, we got that low. The 90-91 correction, we got to 10% below. The 87 correction, we got to 10% below. The 81-82 bear market, you see we got down there. 78, the 77-78 we never did, but 74, 73, 74 we did multiple times before we washed out. And the same thing with the 69-70 bear market. So again, there is precedent for us getting this far below the moving averages in this case. It's not very common to have a cluster. Remember how we talked about how eventually we're going to get the cluster would be the last one? We got that cluster here at the beginning of the year. That was in January, so it hasn't been too many weeks, and we're already this below 10%. The last cluster we got in 21 was in December, and we didn't get below 10% until May. So now COVID, obviously, we dropped pretty far, pretty fast. 2018, we got a cluster. We went to 10% in 3 months. So it's not quite COVID, but it is a lot faster to go from cluster to more than 10% below the 30-week moving average. It's a pretty rapid time frame to get there. If I take a look at the 3 green arrow charts here, let's look at this one first. Obviously, we have 3 red arrows again across the board, all across the board. MACD and stochastics pretty deep, so that's not surprising. If you take a look at the 2-line versions of this, the 30-day now is crossed below the 200. So if we make a run back towards the 30, 50-day moving averages, like we're below the value area now. We broke the value area on Thursday. We're down below it now. Like we are way below the 200. There's your MACD, retesting the low point that I had back over here in March. So again, and the stochastics is much higher low point. So again, I know that the market right now in the after hours is high. Like we're dropping again in the after hours down to 486 now. And if you look at that, that's a really important number, the 486 number, because that's only $20 more down to the 200-week moving average, which is typically where corrections end. Look at that MACD and stochastics on a weekly basis. The volume as high as it is. So This, I wouldn't be surprised if we, after gapping down here at the open potentially, right? Because that's still not even a guarantee that we'll gap down. But if I wouldn't be surprised if we get opened up around 486, that we don't have some kind of rally throughout the day on Monday, considering again, how big of a drop. In fact, like right now, we're down. Let's see, to get down to 486, 564. Let's see, 564.52 down to currently 486.30. So that means we've lost 78 points on the SPY in the last 3 sessions. Now, if you look at and you say, okay, well, how much of that has come out during the actual session? Well, we opened this one at 545.11 and we close at 536.70. So 8 points, 8.41 points. And then this one we opened, try that again. This one we opened at 523.67 minus 505.28, so plus that 8.41. So we've only dropped out of the last 3 sessions, we're down 78 points, 0.22. We've only dropped 28.6 points during the regular trading session. So that means almost 50 points we've lost in very illiquid markets, right? In the very, very low volume, illiquid markets. And one of them being a Sunday night, right? Sunday night moves. I really don't trust big moves on Sunday nights. They tend to not last. So again, I'm fully expecting if we do end up dropping, that we recover some of this pretty quickly. Now, I don't think we get back above the 200-day anytime soon. So we are way below the 200-day moving average now. If you take a look, we can see exactly how far below the 200-day. We are now 12% below. We are approaching, I think the average is around 15% plus or minus a point or two on a correction. And we were at 12%. So we are almost about as below. And again, the 486 is a lot lower than that. So, 486 minus that 200-day moving average is going to be even lower. So, and it's going to be actually significantly lower. And if you look back again at prior corrections, the 2022 correction, we bottomed out at 17% below. That's where we bottomed out there below that, and then we ended up with a higher low during the October low point. The COVID drop, we were 26.5% below the 200-day. 2018, we were 15% below, and so we'll see. I'm of the opinion that we either get a filled-in candle, where we gap down and then we rise up to fill in the gap by the end of the day, or we end up with some kind of long lower shadow on Monday here, considering, again, how far we already are below that 200-day moving average before we even started this after-hours session. Obviously, a lot of these oscillators are going to be extreme now. If you look at the DMI, that negative indicator is at a very, very high level, up there at 47, almost 50. Again, for some perspective, the last time we had it this far, we got to 49 here on January the 24th of 2022. And then that ended up being a little temporary low point. I wouldn't be surprised if this ends up being a temporary low point too, because that's an extreme level for that particular indicator. The RSI and CCI are also at extremes. You can see the RSI is down to 23, well below 30. Again, it's not like we haven't been that far before. We've been down there before. If you look over here, we were at 24 on that January 24th. The CCI, however, is now the second time it's been below minus 300. It was below there in late December. We got below minus 300, as well as in October here we got below. And both those instances were short-term lows that we bounced off of pretty immediately there. So again, down to extreme lows again, and which is going to be even more extreme when we open on Monday. If we hold this after hours, you can see the rate of change. 26-day rate of change is extremely low. We have a very mature bearish trend that's not going to end anytime soon, because you got to get above that blue line for it to end. We're way below the cloud. The cloud's pink. We're not going to be above the cloud when it turns pink. Things we've been talking about before. That's not going to happen. If you take a look at the Bollinger Bands, we are way outside. In fact, it's one of the lowest points. Here, let me get rid of that probability of expiring cone. And let's get rid of the volume profile too while we're at it for now. Don't need to see that, so we can just kind of see the chart a little bit easier. Again, this is the furthest we've been below, and remember, we are opening up even further below, but this is the furthest that we've been below. We never were below this in 2022. We have to go back pretty far to get to this point. Let's see where we at here at minus 41 is how far below. So in COVID, we never got this far below the Bollinger Band. In fact, might have to go back to 1987. Where were we at? 41.9 minus 41.95. So there it is. Again, you can see 2018 we had a pretty decent drop there. 2016 here we had a pretty decent drop. The band was really small at the time, so it's a little different too. In this case, the bandwidth is actually pretty high, whereas back there in 2016 the bandwidth is extremely low, and we bounced out. Same thing with 2018. The bandwidth was extremely low when we broke out in such a large way to the downside. 2015, same thing. The bandwidth was extremely low when we broke out significantly below that lower band. 2011, you can kind of see. So really, like, this is the biggest that we've broken out in the last 20 years easily. The biggest we broke out, especially considering how high the bandwidth was at the time that we actually did break out. And then you can see we are way below the Keltner channel. So again, an extreme as the momentum reverses back down to the downside. Let's take a look at the intraday chart. We obviously have a new 4-week low point, right? And again, we will have a new one on Monday. So your patterns here, the high point dropped down to this range. So your range was actually starting to drop considerably, and then now we've broken back out, and this is one of your bigger 4-week ranges that we've had. And like I said, it will open up even bigger on Monday morning. Obviously, you can see the gaps that are in here, and both of these we gapped and we kind of ran away from the open, so we didn't even come close to filling in either one of these gaps during either of those instances. The volume was extremely high. The trading range, the volume, extremely high in both of them and especially when you include the gaps here, big time jumps in both. So it's made the relative ATR jump way above 2% up to 2.54, and you can see the volume is picking up down there. If you take a look at that relative volume or ATR, we've had bigger during the 2022 correction. The ranges got bigger on a relative basis, because we have to keep in mind that this ATR 12 is actually higher than it got in 2022 on an absolute basis, but at that point the index was at below 400, and now we're at 500. So that's why the relative ATR is not as high, even if the absolute ATR is high. And again, you can see what happened with COVID. You can see in 2018 the ATR. So we've had this kind of volatility before on a relative basis. In fact, when you look at the VIX finally did get up to 45. Here the day before on Thursday, we didn't even close above 30. Obviously, we're well above 100% now. We're above 115% on this. The VVIX is up to 150. Like, these are all like extremes, kind of washout levels on volatility. In fact, when you look at volatility relative to its averages, so one of our bigger jumps that we've had in a while, let's take a look at how far above its 200-day moving average we are on the VIX. Again, 155% puts us right about that level that we were in August of last year. And let's zoom out a little bit so we can get some context on how big of a move that is. And you can see COVID obviously got a lot higher in March of 2022, but after that, like 155% is actually pretty. The 2018 got higher. We were way above the 200 a day. We weren't that far in 2018 at the end of that year. We were about that far above it in 2015. And then you can see here, well, in fact, let's just move this line to 155.15 so we can take a look at this compared to other VIX spikes. 2011 we got about this high, and that ended up being the extent of that move to the upside. The washout phase of that bear market, here's the kind of one of the initial intermediate pullbacks right before the Fed cut rates for the first time. So this is a pretty big jump in the VIX, but it's not the biggest, right? It's not, definitely not. We've seen this kind of jump before, and we've seen it end up peaking here before. Obviously, at the VIX futures end up higher, and you can see the VIX futures here, moving a little bit higher here so far in the after hours, up to 37. But you can see again that's not. It's a pretty big number, but we've again seen it bigger. So like this has been a significant move, and we've obviously, what they say that we've never dropped 5% or 4% on 3 consecutive days since the Great Depression. That's what makes it seem unlikely that we end up dropping, especially if we open down as much as we're opening down right now, because the futures contracts right now are down almost 4%. So if we end up opening down here again, that's the kind of move that sparks an explosive rally. Again, like in this particular case, the zigzag ended up getting again we got down to that 10% number here, and we almost got the 5%. The futures, like I said, the futures actually did get the 5% after that 10% drop, and then now we're down this 15%. But you can see, like, we tend to get double-digit numbers on these correction rallies. We got one in 2022. We got 9% there, and off of COVID, and before we hit the low point, we had a 9% rally. Not so big, but we didn't have as big of a drop either in 2018. 2015, we had a 12% rally coming off of the correction of a intermediate correction low point. So like these kind of moves happen. Like I would not be surprised if we spiked up. Here is the 2011 move. We jumped up 7%, then 8%, then a quick 5% there. 16% move before we got that 10%, that last drop. And then if I go to the bear market, you can see we jumped up 12% off the 200-week moving average there before we fell down and started going. So as we produce this, in this case, a 17% drop without a green tag, that just tells me that the next green tag is probably going to be a really big. When I say really big number, I mean like in the teens, in the double digits, because of how significant and big this drop has been. Again, even if you were to say, okay, let's say that tag does exist. I think I got the 4.3% here. Yeah, 4.6%. We're still down 12% from that green tag. So again, the type of move in a correction that would spark a double-digit tag to the upside. And right now, I think it would take, that 200-day moving average is going to start dropping here pretty rapidly. But like right now, to get to the 200-day moving average, especially from the open here at 487, which is moving. But from Friday's close, to get back to the moving average, which it's going to be moving lower. It's not moving fast, but it's going to be moving a little bit lower. But as it currently stands, let's see here. Let's do it this way. Yeah, let's do it that way. 574 divided by 505. 5028. It would take a 13.5% move just to get back to the 200-day moving average and the point of control, and probably the 50-day moving average would be in that area too. So you can see why you can get such big rallies that ultimately don't change the trend, right? They're just green tags that ultimately turn back into, and like I said, ultimately, like if we get to the 200-day, we still have to drop another 20 points from where we are currently in the after hours. We'd have to drop another 20 points just to get to the 200 week. But we can make a rally here in the next week or two and get back towards that 200-day moving average before we ultimately, kind of like this, right? Before we ultimately make a run back to the 200-week moving average and ultimately finish the correction. Then we get our correction bounce, and we'll see if it fails or not. And because if it fails when we go back below the second time, below the 200-week, then that's when bear markets start, right? Corrections start when you break the 200-day for the second time, as we saw, right? When we break the 200-day for the second time. In this case, it was here in March 26th. That's when corrections start. Bear markets start when you break the 200-week the second time, not the first time, right? But the second time there. Okay, now let's transition and take a look at how some of these other asset classes are performing here. Give me a second for my computer to catch up to me. It's being a little slow here. Let's go to the comparison chart. You can see equities down 20% in the last 3 months. The S&P 500, or at least the Qs and IWM were down 20%. The S&P is down 15%. Gold even came down here in the last couple of days. But let's take a look at these last couple of days just by themselves in isolation. And you can see, again, S&P down 10%. The Qs and IWM both down, 10+%. Gold was down 3%. Almost $1 was down. I mean, everything was down except for one asset class, and that was bonds. And bonds were not up very much. If you look at, bond yields, they didn't go down very much. Now they were down. Let's see here. Let's pull up TNX here. TNX. Oops. Let's try this again. You can see they dropped below 4% on Friday. They were down, I think, a little bit more here, down to like 3.9% in the after hours. So that's a pretty decent drop to the downside, breaking the 200-day moving average, breaking the 50-week and 30-week moving averages here. If I take a look at TLT, that's the one that's like last week finally broke up above these moving averages for the first time in a while, and then now trying to get above the point of control. So, and again, if TLT starts to take a move to the upside, again, that generally means that the Fed will be cut interest rates, right? And if you take a look, that's what these short-term bond yields are starting to price in. So the 2-year bond yield is down to 3.52% here, and this is as of right now here during the after-hour session. 3.52%. The 10-year yield, as I said, was down to 3.9. It's back up to 3.93 a little bit. But remember, we're at 4.25. We're at let's see, where are we at? 4.25 to 4.5%, I believe, is the current rate. Let's refresh this page and try that again. 4.25 to 4.5%. So you're looking at 3.5%. So you got about 100 basis points of cuts in the 2-year yield that's being priced in. The 3-month yield, remember, is the current rate, is down, has now dropped down below the lower band. So now we're starting to price in the cut here at the next meeting. In fact, we have a better than 50% chance now. Now, it's still not, high probability. If you look at June, that's where you have a 100% chance of a cut by June. And again, generally speaking, they like to cut during June. They like to start either the cut or hike during these meetings, unless there's an emergency, because they like to give you an idea of how many cuts they're going to have with their dot plots and their projections, especially when they change their policy and when they change their stance. But it's looking like we might get that emergency here within a month. We might get it earlier than a month, but at least a 100% chance right now of getting one in June. And then if you look at July, it's a 100% chance of a second one in July. And you look at September, we have a 91% chance or 92% chance of a third one in September. So June, July, September. And then you can see by the time we get to, so there'd be 1, 2, 3, a fourth one, you have about a 75% chance of a fourth cut in October. And then when you look at December, again, 1, 2, 3, 4, 5 cuts. You're looking at about, let's see, what would that end up being? So 100, so 100% chance of 2, 98.5% chance of 3, a 87% chance for 4, and then a 57% chance of a fifth one. So that would mean that there's a 57% chance that starting in June, we get a cut at every single meeting. Now, granted, sometimes they do 50 basis points and then they wait and see. Like, we'll see what ends up happening. But remember, and also remember too that the Fed, when they start cutting rates, like, that's typically what they do during correction / bear markets, right? That's when they have their rate cut cycles, like we saw in 2008, like we saw in 2000, like we saw in 1991, 90 to 91. Every other time, there's been only a few cuts here, a few cuts there. 2019 had a few cuts. 1995, 96 famously had a few cuts. 98 had a few cuts with that correction there before they started back up higher again. So there's famous, and then obviously the cuts we just barely had in 2024. Just a few cuts right before we stopped at the beginning of the year, and potentially won't have another one until June. So, and that the idea of a soft landing, that was the chatter. And so there's been a few cuts here or there, but when they cut for a cycle, when their goal of their cutting is to bring the yield curve down, and you can see the yield curve here is still elevated, right? When they had the rate hikes, it elevated all these, especially the short term above these long terms, and they did fall. But now, like a rate cut cycle is what brings them all the way down. You had a little mid-cycle adjustment there in the fall, late summer, early fall of 2019. But the rates were already falling going into those cuts, and you can see the short-term rates were not above. They were briefly there. The short-term rates were briefly above in August, and that's what prompted them to finally cut, because all these rates were falling and there weren't cuts there. So they the tail kind of wagged the dog, so to speak. But usually, like when we're dropping from these elevated levels, it's usually because the Fed's in a rate cut cycle. The yield spread is rising up to the upside, and you take a look at the current yield spread here, the 10-year and 2-year, the current yield spread is jumping, is up to 40 basis points now. We did get up in January up to 42 basis points there and 42 basis points there. So we've been up to 40 basis points, but as you can see, getting to 100 or 200 basis points, that's the norm to get up to. I mean, and usually it's bear markets that get us up, or recessions that get us up to those levels. And we'll see if that ends up being the case again this particular go around. I've been on record, obviously, with a lot of you that I expected that this would be a correction, and this is looking more and more like it. Unlike all the 6 previous corrections that did not lead to a bear market, the 7th one since the last bear market of 2008, 2007, 2008. This one's looking more and more like the type of correction that leads us into ultimately, an extended move. When I say bear market, I mean an extended move below the 200-week moving average, whereas a correction is a move below the 200-day that drops us down to the 200-week moving average, which is what we're currently in right now. Let's take a look at that gold chart. Remember, gold also fell down these last 2 days. Remember, it was so parabolic, and you can see the move it's having, giving us an intermediate confirmation signal. Oversold momentum line, near-term line in bearish territory, but just barely. Not oversold. Momentum line's not extremely. The intermediate line's still above 80. So this is technically a buy the dip type signal on gold. So that will be interesting to see. That won't happen unless we get a move back to the downside in the dollar. And you can see the dollar has this pretty significant, what would that be, a harami pattern, right? Where you get a candle that's actually inside the body of the prior candle, and both of these are pretty decent sized bodies. That's a bullish reversal pattern. We'll see if that continues here, but that's the only. This continues to move higher, then gold typically falls, and gold typically falls during the beginning stages of bear markets. It doesn't rally until later, in the later stages of bear markets. So especially considering how bullish gold has been, and of course crude oil is down quite a bit here so far, but it's been dropping like a rock following where equities are going. And you can see on a 10-week basis, it's really down. I mean, it's been in correction mode already, but it really broke down this past week below the lows of a lot of prior weeks there. So big breakdown in commodities, big breakdown in there's your commodity index there. And again, this is not including today's move, but that's a big breakdown in commodities here. We're way below, 5% below the moving average. Again, that's a sign again of that this is maybe more than just, again, I've been talking about that we've maybe had more than just our garden variety pullback. This may be more than just our garden variety correction. Doesn't mean that we won't get, as I said before, a sharp rally to the upside. I fully expect, and it may be by the end of the week that we start it, but I fully expect that we'll get a sharp rally back up towards that 200-day moving average, and it will be a double-digit move, at least close to it, right? This was close to 5%, but it'll be a double-digit move up. It'll be a sharp move, getting people thinking that the worst is behind us. And I don't think that's going to be the case, considering what we're seeing and some of these moves, and especially considering that we haven't even started our rate cut cycle. And remember, rate cuts are not bullish, right? Rate cuts, if we're cutting rates over an extended period of time, month after month after month after month, that generally means that this is more than just your garden variety correction. They might spark some short-term rallies to get those green tags, but the fact that we are cutting, the fact that we need to cut, means that the economy may not be able to change, and the sentiment which has been so bearish, that AAII sentiments that I've been showing you before, continuing to be bearish here. That's going to take quite a bit to change that. I mean, we are so strongly bearish from the sentiment survey. One rate cut might not be enough to get it back to where we need it to be. I mean, look how strong. This is worse sentiment than we had at the beginning of 2008 when that bear market started. We had a big drop in sentiment there. We had a big drop in sentiment in 2022. I mean, this is worse than both of those when you look at this PPO or this MACD on that 1226 time frame. So we are, the orange line here is extremely low. It's lower than it was during any time during the Great Financial Crisis. Was lower a couple of times here in 2022, but this is pretty significantly low considering that the 40-week moving average of this is actually still positive. All these other times that we've been this low, the 40-week average is down pretty significantly. Even over here when we were just getting below 20, the 40-week average was already negative. So for us to be below 20, below 25 on the 10-week average, but to still be positive on the 40-week average, just goes to show how extreme the sentiment is and how hard it would be to change that sentiment. But from a breadth standpoint, you can see we're below minus 2,000 on the net new highs and new lows on both the NASDAQ Composite and the New York Stock Exchange. The new lows on the New York Stock Exchange jumped up to an extremely high level above 1,000. That's an extreme level for this. You can see the number of stocks above the 50-day moving average dropped down to below 100. In fact, it's flirting with getting below 50. That's the 10% mark. As you can see, that's an extreme low for that number. The number of stocks above their 200-day moving average is now flirting with getting below 100, which would be 20%, right? So this is the lowest level that this index has been in quite some time. Again, you have to go back to the COVID to get a draw. Well, 2022 a couple of times we got down below minus 100. COVID, of course, but you can in 2008, 2009 during the extremes. At the beginning, we dropped below 100 of 2000 during the correction stage of that bear market. We were down this low on the number of stocks above the 200-day. So we are, the breadth has really significantly moved to the downside, to extreme washout type lows. When you look at the McClellan oscillator, this did not get below minus 100, which would be the washout level for this, but it's definitely back below minus 35 again, and the summation index is working its way down to minus 500, which is where it typically gets when you are in the correction stage of a market. And again, for some perspective when we had our last bear market back here in 2008, 2009. You can see here, we got below the minus 500 a couple of times during the early stages of this, during the pullback stage, and then during the correction stage, and then we bounced back up. We never got back above. We got above zero. We never got above pies of 500 before we really spent a lot of time below that. We really washed out from a breadth standpoint. So we are not at that point yet. we're below zero, and we have a minus 59, but we are not at the washout stage where we are at this minus 100 level, where we really wash out on a daily basis. So nowhere even close to that. And the money flow, as I mentioned to you before, that's also another key sign of just how bullish or bearish we are. Let me try this again because it's being really slow for me. So give me 1 second. There we go. You can see, so we are way below. Let's try that. Sorry, my cursor is not moving. So let me try this one more time. There we go. So here's the lowest point that we had in March, and we are way below that in terms of price. We are not below that. We are not that far below it in the money flow. In fact, if you look at the money flow, we are kind of at the same levels as we were here at the peaks, and you can see we're way below those peaks. Again, coming down here to 350. We are near the same levels we were there too at those peaks. And again, when you look at the price now, this is a big drop, but it's not nearly the same. You can even see the money flow index is not to an extreme either. So, another case here where it suggests that, again, even if we gap down, I wouldn't be surprised if we filled in today's gap pretty quickly and we started our run to get the green tag, at least to a 5% move, if not closer to 10%. Again, won't happen in a day, but it will be very quickly. It will be relatively quickly, to the point where, again, I think most people would think that the worst is behind us once we actually do get it. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody. We'll see you on Monday.